All right. Welcome, everybody. Appreciate those who are here and appreciate you guys waiting a couple minutes. My name's Braden Mulkeen. I help oversee business development at SumZero for those who we've not connected yet. Today we have Elijio Serrano, CFO and Vice President of Tetra Technologies, alongside Scott Preston, a longtime SumZero member who actually wrote up a bull thesis on Tetra back in June of 2020, I believe, when it was trading under $1 a share. Mr. Serrano has actually served as Tetra's Senior Vice President and Chief Financial Officer since August 2012. Prior to Tetra, Mr. Serrano served as Chief Financial Officer at Universal Pegasus International, a global project management, engineering, and construction management company from October 2009 through July 2012. Scott, like I said, is no stranger to SumZero. He's been managing portfolio manager and general partner of Maven Group since its launch in September 2007. Prior to that, he spent time on the institutional equities desk at Citigroup, spent time at equity research desk at Research Capital Corp, Silicon Valley Securities, and TD Securities, subsidiary of TD Bank. So without further ado, I'll let these gentlemen take it from here. Scott and Elijio, appreciate the time and very much looking forward to the conversation. For those who have joined us, and I'll put this in the chat as well, but please don't hesitate to ask questions, type them out in the chat as we go along. We'll look to address them on the call, and if we can't get to them, we'll follow up on SumZero. But Scott, I'll leave it to you, sir.
Okay, thanks for the intro. I thought now would be a great time to have Elijio on to kind of tell the Tetra story. Lot's changed since I originally wrote it up and the catalyst around the stock. And I think it might actually be more interesting today than it was back in 2020. So Elijio, maybe you can just give us a quick 2 to 3 minute intro on Tetra, and then I can jump in from there with some specific questions.
Okay, thanks, Scott. Really appreciate the invitation from SumZero and Scott to participate. Look forward to the dialogue. I'd like to encourage everybody first to read our forward-looking statements on our latest investor presentation on our website. Scott mentioned that I've been with Tetra for a while. In addition to my prior CFO job, I spent 17 years at Schlumberger, the largest oilfield services company in the world. So I've been with Schlumberger and Tetra a total of 27 years, got quite a bit of oil and gas experience. Tetra's been public for 40 years. In the last couple of years, as Scott mentioned, we've taken significant steps to reposition the company. We've eliminated a capital-intensive compression business and also sold an offshore decommissioning business whose earnings were not predictable enough for our standards. We are now focused on 2 segments, serving the oil and gas and the industrial chemicals business. Our core strength is aqueous chemistry. On the onshore side, we've got a capital-light business focusing on managing the water logistics around the well site and treating water. We are not capital intensive and do not own pipelines, do not own disposal wells, do not have a big trucking operation. On the offshore side, we're vertically integrated, where we produce specialty chemicals to sell to the oil and gas operators to complete their offshore wells. These chemicals manage the pressure of the offshore wells to prevent blowouts like what occurred with BP Macondo many years ago. Additionally, we're one of the largest producers across the globe of calcium chloride that has many industrial applications. We focused our 2 segments with what we believe to be 2 markets with barriers to entry, technology differentiators, and have limited number of competitors in some of the key areas that we're working on. Our business model has proven to be quite resilient. We have stayed both EBITDA and cash flow positive in the last 2 significant downturns during 2015, 16, 17. And again, even when the market collapsed around COVID in 2021, we stayed both EBITDA and cash flow positive. Then in addition to the reposition of the portfolio, early last year, we received good market reaction when we communicated to investors a path toward bringing to market some critical minerals that we've been holding mineral rights for. And this minerals have a strong market application in battery storage. Over the next few minutes, we'll talk a little bit about the minerals that we have access to in Arkansas that we're going to work to develop that we think will take us beyond the traditional oil and gas services and move us into the energy transition market. So Scott, maybe with that overview, let me turn it back over to you.
Okay, thanks, Leo. Let's start with the water and flowback aspect of the business. And I think this is an important part to touch on first off, just, I think overall oil service has been extremely volatile over the last year. However, this cycle feels significantly different than past cycles, with both the producers being a lot more disciplined, as well as the oil service companies themselves being hesitant to really crank up the CapEx. So you guys did about 66 million in 2Q in this business, getting back towards prior peaks. Can you talk about maybe the evolution of how you see this business progressing over the next 2 to 3 years, if we kind of assume a $70 to $90 oil price? And the rig count and frac count has definitely lagged its trajectory as in past cycles, but how you guys think you can still grow this business with that range of oil prices? Is this going to be a function of market share? Should we expect some incremental CapEx from the industry? And then or new services?
Mm-hmm. So Scott, this business did about around $300 million of revenue in 2018 with EBITDA margins of 21%. Currently, we're on a run rate to hit about $250 million in revenue. And last quarter, we did over 15% EBITDA margins. Now, the activity has been significantly lower. In 2018, there were over 450 frac crews operating. And today we're running with about 250 to 260 frac crews. So you're right, discipline from the operators is significantly more than what it was in the past. And despite lower activity, we're generating revenue that's already approaching our historical highs. And we believe that our EBITDA margins will match what our historical highs have been. And this has been as a result of 3 items. Number one, we've introduced a lot of technology that reduces the number of personnel we require at the job site, and therefore our margins are significantly stronger. Number two, we've moved a lot of our activity to not be dependent on drilling and completion of new wells. We have moved into the production side. So as wells are producing after they've been completed, we can now generate revenue, either filtering sand, treating water, and moving water after the well has been brought online. So we don't need the number of rigs and the number of frac crews that were operating before. And then the third area is that we've expanded into areas like Argentina, where the shale play market there has become more robust. So I think the combination of new technologies coming on that have created incremental competitive advantages, moving to the production side instead of the completion side, and then expanding into markets like Argentina will allow us to meet historical targets, even though drilling and completions activity might not meet what it's been before.
That's great. One I think you guys have talked about in the last couple of calls, one aspect of this business that I think is maybe a little bit underappreciated, and I think pretty unique and differentiated in the industry is Sandstorm. Also probably one of the fastest growing segments of kind of water in that kind of water and flowback. Can you talk about the opportunity and the differentiation of Sandstorm and maybe where you kind of see that going over the next 2 to 3 years?
Good question. So Sandstorm is a technology that removes sand coming from the well. When you bring a well online, you've got a lot of the sand that was injected to frack the well coming up with the oil. And if you leave the sand in there, it'll cause problems in the midstream system. It's the equivalent of high pressure jetting the midstream system as the oil is flowing at a very high rate. And with the sand in there, it does quite a bit of damage to the midstream system. Historical technologies removed only about 60 to 65% of the sand coming out of the well. And it was very people intensive. In the last couple of years, we've developed a technology that removes as much as 99% of the sand coming out of the well. And other than people setting it up, we don't require any personnel at the website, at the well site, to be able to clean this through. This technology has given us a payback of 12 months or less. We've gone from almost no technology deployed in this area to now about a 15% market share. We think that within the next year and a half, we can double that to about a 30% market share. And our patented technology does not have any competitors out there that can match the type of filtration that we have. So we are very aggressively pushing this, and a lot of the customers that get exposed to this put it on all the wells that they have in production.
Okay, thank you. And then finally, in this aspect of the business, and I think maybe the most exciting, a little bit longer term outlook for it is the water reuse. And I know this is at very, very early stages, but can you talk about where you're at on this and the hurdles that kind of remain in front of you to getting towards water reuse and water recycling, and eventually towards surface disposal?
So for those of you that are not familiar with produced water, when you bring a well online, there's a lot of water coming up with chemicals and all kinds of items that need to be removed from it. It is not uncommon that you see a ratio of 8:1 for every 8 barrels, for every barrel of oil that you might bring out of a well, you might get as much as 8 barrels of water. And this is dirty water that needs to be treated and disposed of. Historically, operators have removed this water by disposing of it in saltwater disposal wells, which means that it needs to either be trucked or moved by pipeline to be disposed of. Now, when you dispose of so much water, and last year we had over 20 billion gallons of water that was produced and needed to be disposed in the oil and gas sector in the United States. Now, when you inject so much water, you're starting to cause seismic events that are having environmental issues. We've developed a relationship with 2 private companies that have a desalination technology that is being applied in markets outside the oil and gas. And we've licensed their technologies exclusively for the oil and gas sector so that we can take this dirty produced water, clean it up to the point of being surface discharged or being used for crop irrigation. Now, desalinating water is not new. It's been done in the Middle East and many parts across the world for many, many years. But the amount of energy that it consumes to do so makes it cost prohibitive in the oil and gas industry. We believe that we can apply this technology on a mass scale in the oil and gas sector and reduce the cost of the operator from anywhere from 50 cents to $8 a barrel, and take this water and allow it to be surface discharged, including crop irrigation. The 2 biggest challenges to overcome is, number 1, the standards of what is determined to be surface discharge. The EPA has already set a standard that we are meeting. States of New Mexico and Texas are also setting standards that we are hitting those standards in the lab environment. So now we have to coordinate between the different states, agencies, and local regulatory agencies to make sure that there's a consistent standard out there, and then deploy this so that the amount of energy being consumed is manageable and cost effective. I expect that before the end of this year, we'll be out with a test unit with a major oil and gas operator that will look at proving this out in a field environment. And we expect that by late next year, we'll be generating revenue by cleaning up produced water for surface discharge.
Okay, and then what kind of market opportunity do you think this would, incremental market opportunity, do you think this would approach in if you are able to accomplish getting over those hurdles and those thresholds? Would this be a $100 to $200 million opportunity fairly quickly, or do you think more or less than that?
It's very practical to believe that we can be hitting in excess of $100 million of revenue when you look at 20 billion gallons of water being disposed of. And even if we bring it down to $1 to $2 cost for the operators, the opportunity is huge, especially given all the pressure that the operators are feeling with the ESG and the environmental angle. And in addition to the cost of buying fresh water to dispose of it, especially when you take into account the drought conditions in Texas and New Mexico and the pressure to try to address some of the environmental issue. We think that this has the ability to completely re-rate this segment, which has historically traded on a multiple of between 4 and 6 times EBITDA, to push it into a high single digits, low double digit multiple, given the growth profile to be coming from produced water.
Okay, so probably one of the lower friction opportunities for you in the near term, I would say.
That is correct.
Okay. All right, great. Let's jump into the fluid side of the business. And I think first off, just because this kind of what provided, was a little hiccup for you guys in 2Q. So if we can maybe you can just describe your industrial business that you have on the fluid side in Finland, kind of the minor hiccup you had there in 2Q. Can you talk about if that's been resolved, if you expect any other issues with that, into 23, and then maybe some adjacent market opportunities potentially you have on the industrial side for fluids?
So this segment is quite strong for us. The peak earnings over the last 6 years was $284 million revenue, and we're already approaching those levels. Out of that $284 million of revenue, about $100 million is non-oil and gas. It comes from calcium chloride. Calcium chloride has many broad applications. It goes toward de-icing airplanes, dust control. It goes into a food preservative. Some bottles of water actually contain calcium chloride in the water. So it's got very broad applications, and it moves at the speed of GDP. That $100 million of our revenue from the calcium chloride business we view it as a steady Eddie, very predictable, consistent year-over-year performer, generating about 25% EBITDA margins. In the second quarter, one of our key raw materials that we require for a facility in Europe was in short supply as a result of the Russia-Ukraine conflict. We have since found alternative suppliers, and we expect that on a go-forward basis to be significantly less than the $1.3 million impact that we saw. Now, this business is also growing. We're finding new applications. We believe that calcium chloride will have an application in the production of lithium, and we started selling to a lithium producer in South America during the third quarter, calcium chloride, so that they can use that in their process of producing lithium. We also believe that going into the future, it can be a key input in CO2 capture, where CO2 can be reacted with calcium chloride, and a marketable product called precipitated calcium carbonate can be produced. So not only do we have a steady, consistent business, we believe we got a business that's got growing applications for its core product. Now,
Okay.
and I was going to add.
Oh, go ahead. Sorry, Lee.
I was going to add the other $200 million of revenue is primarily deep water oil and gas business, of which we're in the very early stages of what we believe to be a multi-year recovery. And to give you a sense as to the strength of this segment, last year, 2020, 2021, and the first half of this year, our EBITDA margins have been between 26 and 28%, despite a collapse in 2020 and 2021 of the global economies from COVID.
Okay, yeah, I was just actually going to jump into that. But first off, just to follow up on the industrial business, would you expect with these kind of adjacent applications that, it's been a GDP growth type business how might that growth rate change? Should we expect something that's more double GDP growth going forward, or how, can you put that in some context?
Yeah, that's very practical. I think in the short term, maybe have 50% on top of GDP as the adoption of calcium chloride into the lithium extraction process gains traction. And then if it gains traction, like we think it will in the capture of CO2, we think that it can more than double GDP in the future years.
Okay. Okay. Perfect. All right, you touched on it just a second ago, your fluids business for offshore, I think position, one of the last businesses come back, offshore's still down significantly since, 15 and even kind of the last mini cycle in 18. We haven't seen much of a recovery there at all, but the overall, your business has held up okay. How do you see, when you look at investment in the industry, we're starting to see some offshore rigs come back, but where do you think this business can go over the next, 2 to 3 years? And we can jump in the Neptune after this, but maybe X the Neptune business, kind of how do you see that trajectory with what you're seeing currently in the offshore market?
Yeah, the peak was 2014 and 2015 for the deep water market. Just as an example, in the Gulf of Mexico, deep water rigs were approaching 40 in 2014, and they dropped all the way down to about 15 deep water rigs. Today, the rebound has been very modest. We're still in the 16, 17 deep water rigs in the Gulf of Mexico, as an example. Following our customers, talking to our customers, looking at the drilling companies out there, there's a significant number of new rigs coming online. Contracts are being signed for more rigs to be deployed. When you look at the deep water activity and the equipment required, you're seeing long lead items being ordered to address some of the deep water drilling activity. We fully believe that we're in the very early start of a deep water multi-year run. The cost to complete and make successful a deep water well has dropped to as low as $30 a barrel. So even if we stay in the $50, $60, $70 oil range, we think the super majors and the large independents, companies like Saudi Aramco, are going to be very active in the market. The more deep water activity occurs out there, the more need for our fluids. The volume of fluid that we sell is dependent on the depth and the pressure of the well, of which those have been in short supply in the recent years. And again, repeat that even in the recent years, when those were in short supply, we're still generating mid to high 20% EBITDA margins in this segment.
So do you think, with oil prices consistent within the range they are today, we could see the offshore fluids ex Neptune grow more than 20-25% in 23?
We think that there's about a 1-year lag from the well at the time a well starts to be drilled. Just as a comparison, an onshore well might be drilled in 3 weeks. An offshore well could take 6 to 9 months, assuming that the subsea infrastructure is in place, to pipelines to bring everything back to the refineries onshore. If you're doing infill drilling and bringing new wells online where an existing infrastructure exists, you could see the impact within 6 months. If you have to build out that infrastructure and connect all those new wells to an existing pipeline network, then it could be as much as a year. A lot of the actions that we've seen are already 3 to 4 months into that process. So we think there's an opportunity in 2023 and 2024 to make a meaningful increase over the levels that we're seeing today. And we've already are talking to customers about significant projects that they want us to plan for.
Okay, that's great. All right, now if we can maybe jump into Neptune, I think this is obviously a huge opportunity for the company. You had a couple Neptune wells a few years ago. There's been some Neptune deals that have slipped, although mostly out of your control. I think Neptune is super interesting as well because of its you could call it ESG benefits, but in general, great environmental benefits over kind of alternative solutions. Maybe if you can talk about the Neptune funnel and maybe really highlight how the product itself is really making inroads in the market and being accepted, but there's different characteristics of the well which will determine whether it's used or not. So it's not a Tetra losing deals or higher friction with with producer adoption, but it's more just how the well end up developing throughout the drilling process. And then maybe you can kind of walk investors through all those things, and then maybe kind of what you'd expect, as far as Neptune deals, as this offshore market progresses over the next couple of years.
So a little bit about Neptune first. So this is a unique technology that we developed jointly with Exxon. We own all the patents to this technology. Exxon came to us about 8 years ago saying that they needed to solve a problem with high pressure wells and asked us to work with them to develop the technology. And we developed that technology. We have since done 5 major wells with Exxon in the Gulf of Mexico. In fact, Exxon jointly published a paper at an industry event last year acknowledging our technology. So imagine that you're drilling a well deep water Gulf of Mexico. You're drilling through 2 miles of water, and then you're going another 2 miles into the earth. So all the gas pockets are under significant pressure. You've got 2 miles of the weight of water. You've got 2 miles of the weight of earth on top of this pockets of gas. As soon as you hit that pocket of gas with your drill bit, if you don't control the weight of that well, everything blows out to the surface. The drilling mud is originally in the formation to keep all those pressures under control, but you can't perforate a formation with the mud in there because it'll clog up the formation. So where we come in is after the drilling has been done, the drilling mud is removed, and then we inject our fluids, our completion fluids into the well. Now, if the pressure's not high, it's a basic fluid like sodium bromide. If it's a little bit higher pressure, it's basic calcium bromide. And then if it's higher pressure, it's zinc bromide. The problem is zinc is corrosive and banned in many parts of the world. So we developed a technology that is called CS Neptune that has the same weight and density characteristics as zinc bromide without any of the corrosive nature of zinc. Now, these are for very unique wells that are ultra high pressure. We can easily generate $15 to $25 million of revenue for one of the wells, and the margins are incredibly high, much higher than the segment EBITDA margins that we generate. But these are unique wells. You would have expected that in a period of high activity, you could see 1 to 2 or potentially 3 wells a year. And in periods like we've been in the last several years, we haven't seen many of those wells. Today, we've identified several significant deep water wells that our customers are testing our fluid. They've already signed off that our fluid will work in their wells. Some of those projects have already been started drilling, and we expect that we'll be performing Neptune jobs next year on some of the identified opportunities. Now, we have not lost a single Neptune well to a competitive product because there really is no competitive product out there. Some of the projects that we expected to have been completed turned out to either be dry holes, or once they drilled the well, the pressure on that formation was not as heavy as they anticipated. So they still used a basic calcium bromide solution from us. So based on feedback from our customers, there's a significant backlog of Neptune opportunities coming our way that we expect to be on 2023, 2024, and beyond.
Okay, excellent. And would you say, at least from my perspective, even 2 Neptune wells for you a year would be pretty transformational for that side of the business? Would that be a good way to? I know you don't like to talk about the financials around Neptune in super granular detail, but would that be fair to say?
Yeah, if you go back and look at our historical quarterly results over the last 6 years, every time we did a Neptune job, the EBITDA margins would go from the mid-20s to the high 30s. To the mid to low 30 EBITDA margins for the segment. And that tells you the power on our results from one well, moving the entire segment from the mid-20s to the low 30s to mid-30s EBITDA margins.
Okay. All right, great. All right, now maybe if we can jump over into some of kind of the newer things that have transpired, and you touched on your mineral assets in the Smackover Formation in Arkansas. You did release kind of an initial inferred resource in about mid-September there. It implied about 20 billion in just bromine, I think, if I'm doing my math correctly, at 5.2 million tons, which is a lot. You're expecting a PEA by the end of the year, which will give you, a lot more economic details. But, assuming that comes in at, around expectations, can you maybe talk about the timeline and the next steps the company will take to, start, mining or producing bromine from that asset if it is economical?
So our investor presentation on our website, there's a nice slide. And if you look at it, take a look at slide 18. So Tetra, about 30 years ago, to make sure that we had enough access to bromine for our oil and gas applications, we went out and secured the mineral rights to about 40,000 acres in Arkansas to brine. Brine is where bromine comes from. Now, we've never exploited and brought those assets to market because we're in the middle of a 20-year agreement with a chemical manufacturer we take their elemental bromine and convert it into a finished product. So we've been sitting for close to 30 years on mineral rights in Arkansas for the brine minerals. Now, brine is rich with bromine, and it's also rich with lithium. We've completed some work, drilled some test wells, hired some independent consultants, and they've estimated that we've got 5.2 million tons of bromine on those 40,000 acres. Bromine has recently been selling for about $4,300 a ton. So you can do the math and see that the in situ value is huge. Now, brine is also rich with lithium. And on that 40,000 acres, we've got about 1.5 million tons of lithium. Lithium has gone from about $8,500 a ton to slightly over $70,000 a ton. Do the math, 1.5 million tons times even 30,000, take a midpoint. You can see that that's a huge number. Out of that 1.5 million tons of lithium, we signed an option agreement with a Canadian company called Standard Lithium, to where we give them an option to around 35 of those 40,000 acres for them to drill, bring the brine out of the ground, get to the lithium, and if they sell that lithium, we get a 2.5% royalty. They published a preliminary economic assessment a couple of years ago, estimating that even at $14,500 a ton, they could be paying Tetra close to $400 million in royalties on that 1.3 million tons that they've got an option agreement for. We kept on 5,000 acres all the rights to the other lithium, and that's about 234,000 tons that we're sitting on. So today we're going to focus on meeting the demands for battery storage from bromine, from a growing oil and gas market, and begin working toward bringing the bromine from those leased acres to market. We've been doing this for going on 30 years now, so there's not a technology challenge to overcome. We believe that the volumes we're getting from the chemical producer are not going to be sufficient, and the incremental bromine that we bring, we think are going to give us significantly more volumes to meet a growing market. And also, we're going to be able to extract it and bring it to market at a lower cost than what we're paying the chemical manufacturer. So we see upside on volumes and margin enhancement from the bromine.
Okay, that's great. Elijio, you answered a couple of my follow-ups, but I think one thing you touched on the Standard Lithium agreement, and I think a couple points maybe you should describe for listeners. One, that you will be getting for free the bromine offtake from the Standard Lithium acreage. So that would be obviously a huge benefit for you. And then there's been a little controversy around Standard Lithium and their extraction process, but if Standard Lithium goes away and if that people want to model that downside scenario, you would retain that acreage back from them and then could then potentially extract the bromine from that yourself.
That's correct. And a good clarification, Scott. We own the bromine on all 40,000 acres that we have the mineral rights to. And we own the lithium on 5 out of the 40,000 acres, and Standard Lithium has an option agreement. So if Standard Lithium were to determine that they wanted to start drilling to get to the brine and pull out the lithium, at the same time, they're pulling out the bromine and handing it over to us without us having to make any capital investments. Now we're going to go through this in 2 processes. We've already published data that quantified how much minerals we have, both lithium and bromine on that acreage. By December of this year, we intend to publish what's known as a preliminary economic assessment, or essentially the business model or a business plan. How much bromine can we bring to market? What is the capital required to do so? What is the cost to produce that bromine, and what incremental margin we can make? So expect that in December, we'll be publishing a full business model, and that'll be the first time we'll put a bogey out there in terms of how much incremental revenue and EBITDA we can generate from the bromine assets coming to market. We'll do the same with lithium toward the back end of next year. So this December, expect a business plan or a PEA for bromine, and about a year later, a PEA or a business plan for the lithium.
Okay, fantastic. And you did touch on this before, but just to make it clear, and I think it's a point that is important for listeners to understand, is that although lithium extraction, there's a little bit more complications and debate about, the process for bromine extraction has been time tested. You've been doing it for decades. The hurdles there are very, very low, and there's not technology and different know-how that needs to be overcome.
Exactly. And today we've got a plant in West Memphis that is taking elemental bromine and converting it into a finished product to be used for battery storage, or a finished product to be sold to the oil and gas sector. Drilling the wells and bringing more brine to get to the bromine is something that's already been done, and it's been done for the past 50 plus years by many in the industry. And we've been converting the elemental bromine to finished product for 30, 40 years now in West Memphis, Arkansas.
Okay, great. Well, now would be I think a good time to jump into the battery side and the opportunity there. You have one deal with EOS, EOSE, publicly traded company. They've had some missteps, but now they're actually starting to ramp quite substantially. You should see some benefits there. Can you talk about potential other customers out there? Is this an opportunity where there's 3 or 4 companies you could potentially be selling to? Is it a dozen? Where could this market kind of unfold over time? And really, how many different customers do you think you could be selling this PureFlow product to?
So battery storage, all the headlines go to lithium for electric vehicles. But, a lithium battery is short duration charge and discharge. If you wanted to capture power from wind farms, solar farms, and feed the grid, you would need something that's longer duration charge and discharge. There's some technologies that are being developed. One of them is by this publicly traded company, EOS, to where they take zinc bromide and use it as the electrolyte for their batteries. Imagine your car battery that's got the acid in it. Imagine that big enough to fill a tanker a truck that is on the road, and put many of those together. Instead of acid in them, they fill it with zinc bromide electrolyte, which we're manufacturing in Arkansas. EOS has started to build a significant backlog. They've got a backlog of in excess of $450 million. They've got a pipeline of identified opportunities over $5 billion. So this is something that is already commercially proven to work. Now it's a matter of them ramping up to meet that demand. If you look at the consensus for EOS, revenue this year is $50 million. Next year going to about 180, then going to about 450, then going to about $800 million in revenue. We represent somewhere between 15 to 20% of their revenue for the electrolyte that we sell them to go in their battery. So if you look at them moving from 50 up to $800 million, you can see the impact that it could make on the volumes of zinc bromide that they require from us. Now, Eos is ahead of most of the others. There's another publicly traded company traded outside the United States that's also on the verge of launching their production of a comparable battery. Expect that before the end of the year, we'll come out and announce who the next Eos type customer is. That'll be the second significant customer we have in this market.
Okay, that's great. And how would you compare the margins for this product versus your bromine-based oil service fluids? Is it something pretty comparable or above or below?
The fall through margins will be significantly better. Imagine that
Okay.
if we want to sell our offshore product across the globe, we need a complete distribution network. In facilities, we need a sales organization. We need a complete distribution network and infrastructure to get it out there. Selling to Eos, we'll manufacture it in West Memphis. We'll put it in tote tanks and ship it directly to Pittsburgh without adding any infrastructure at all to it. So the fall through margins will be better than our oil and gas business.
Okay, that's excellent. And then finally on battery, can you talk a bit how PureFlow is differentiated? Some might view this, oh, it's a commodity chemical. You could have batteries considered lower margin. They're going to be constantly looking to lower their costs. Could you be subject to competition on the input side? And so can you talk about maybe how the product's differentiated and what moats are there to potentially limit a competitor product displacing you?
Yeah, the two key inputs to the electrolyte are zinc and bromine. And you have to blend them and eliminate all impurities to be able to charge and discharge over an extended time period. We have developed a patented process over many years to produce an incredibly high purity zinc bromide solution that is critical for a company like Eos. Now, other chemical manufacturers, the big bromine manufacturers in the world, like Albemarle, Israeli Chemical, or Lanxess, the only competition we have today is an import coming out of the Middle East. And you've got logistics issues with global supply chain challenges, and you've got the lack of security in your supply chain to be able to do that. If you listen to the Eos sales pitch, they're waving the American flag, saying that they've got a U.S. supplier, a U.S. base. They're looking to secure government funds to ramp up. So they're basically laying out a solution to where Tetra is their key provider. So I would suggest that the combination of our existing infrastructure, our patent, and our customer heavily waving the American flag as a supply chain competitive advantage plays perfectly into the hands of us growing with this market opportunity.
Okay, excellent. Well, I think maybe we can finish off with capital allocation. You guys have a ton of opportunities in front of you, whether it's some smaller capital investment stuff like Sandstorm or the water discharge, to the bigger side of the business like the Arkansas Smackover assets. You have $36 million in cash. And about, I think, $65 million in available on your credit lines. Can you talk about kind of the puts and takes on the cash side, between free cash flow that you should be generating from the core business and battery, and then, what different avenues you potentially have to fund the development of the Arkansas assets?
So Scott, we previously mentioned on some of our earnings calls that we expect to be generating between $25 to $30 million of free cash flow per year. That's after funding the maintenance and growth capital opportunities in the oil and gas business. I would suggest that plus our liquidity of what you mentioned, almost $100 million, will meet the vast majority of the capital that we need to bring our bromine assets to market. which is where our first focus is going to be. When we get to the lithium part of it, which is probably a year after that, we'll look at the capital markets available, knowing that our leverage ratio, it has dropped materially, and we're at our 1.7 times leverage ratio out there. So funding the bromine, we feel very comfortable. We've got our hands around that with existing liquidity and free cash flow being generated. And then we'll revisit how we attack the lithium opportunity. But by that point, we'll have more bromine profit coming online from the incremental volume and margin that we discussed earlier.
Okay, that's great. So you wouldn't expect any sort of equity, investors shouldn't expect some large equity issue to fund the bromine extraction in the near term.
Management of the board are very reluctant to use our equity in any of those initiatives.
Okay. All right. Well, that kind of wraps up my questions. Braden, I don't know if you have any questions from the audience for Elijio.
Nothing came through during the call. If anybody has them, you can type them out here, and we're tracking the chat.
And I'll volunteer that my phone number and email address are on all our press releases. Encourage you guys to reach out to me for any additional questions that you guys might have that do not get raised during the call today.
Excellent. We appreciate that. If there are no questions, obviously Scott's full-length thesis is on SumZero. For SumZero members, you're welcome to address or add questions to the comments section of that report. Elijio and Scott, and for all who joined today, we very much appreciate the time. And I will say we apologize for what happened. Never in our lives has that happened here. So of most importance, I think this is a very compelling conversation. I think the opportunity laid out was tremendous. So Elijio and Scott, we very much appreciate you guys coming on board and sharing your thoughts here with us.
Thank you. Really.
Great. Thanks, Brian. Thanks, Elijio.
Thank you. Appreciate it.
Yes.
Bye.